Okay, hello, hi guys. I hope you people are doing well. First of all, thank you very much for joining in. I know it's a bit of an odd time for some countries because in some countries it's morning, in some countries it's afternoon, in some countries it's like evening. So I know it's a bit of an odd time, but I thought that maybe those who could not attend live can probably get the recordings of these sessions and can take advantage of the recordings. So my agenda, I mean, like before, some of you might actually not know me. My name is Luqman Rafiq, and my uh, small background is that I've been in teaching profession for more than 13 years now, and I've been teaching different papers for the ACCA qualifications, including the financial management, both the FM and the AFM, the performance management, both PM and APM, the reporting, which is the SBR. So that's what I have been up to. Um, Now, the agenda of the session of today and the subsequent sessions on the financial management is that I would take you through the examination questions. The reason of taking you through the examination questions is that I think that it's the best method to practice it's the best method to practice for the examination, and I'm sure that you people would have covered up the entire syllabus by now. So I think the best thing to do is that to practice the examination questions. Now, I would have ideally wanted to practice using the ACCA CBE practice platform, but unfortunately nowadays what's happening is that at times the CBE practice platform is not responding, so you end up wasting a lot of time. So I thought that I would rather use the revision kit, and I would take up the questions from the revision kit and would take you through them. So I'd be using the latest revision kit published by the BPP, and I would be doing the questions from that revision kit. Plus, I would be doing the workings on the Word and the Excel. And what I will do is that I will share those workings with you people so that you can have access to them and you could use them. So I'm just going to start off. Okay. Now I do have this revision kit of the BPP, and this revision kit is one of the latest kit of the ACCA. And what I would be doing is that I would be taking you people through the different examination questions on the different topics. So the topic that we are initially going to start off with is the investment appraisal. And what I would try to do is that I would try to take you people through some of the section C questions on the investment appraisal, and then we're going to move forward. So let's start discussing. I would try to do some of the latest questions like March, June 2021, March, June 2022, and the December 2021. So I would try to do some of the latest questions so that we could have a good idea as to how to deal with the things. Okay. Okay, so the question that we have is, the name of the question is Cabrera's Companies. Cabrera's Companies. Now let's just start discussing about this Cabrera's Company. And let's see that what exactly is the requirement of the question and how we'll be able to do the questions requirement. See, it says the company is a construction company. The company is a construction company. It uses large earth-moving vehicles called the Beast to prepare the foundations for the building. So what is it? It's a large earth-moving company, and basically to prepare the foundations for the building. It needs to decide whether the cheapest replacement interval for Beast is 3 years or 4 years. So it's a construction company, and it needs to decide whether it should actually be changing the machinery every 3 years or every 4 years. Now, the following details are available. What exactly are the requirements of the question? Let's try to do the requirement of the question. It says calculate the equivalent annual cost of the 3-year and the 4-year replacement intervals for the Beast and advise which replacement interval to adopt. So you got to see that the 3-year replacement cycle is suitable or the 4 years replacement cycle is suitable. Discuss why replacement interval decision should be based upon the equivalent annual cost, and discuss why discounted cash flow methods of investment appraisal are considered superior to non-discounted cash flow methods. Now see, it's a 20-mark question. Out of the 20 marks, the 9 marks are the discussion marks, 11 marks are the calculation marks. So we try to see that how we can get the maximum marks through this question. I repeat, you try to see that how we can get the maximum marks through this specific question. Now let's just start doing this question now. So see, this is Kerberos company. This is Kerberos company. First of all, what I would do is that I would actually explain to you that what is this equivalent annual cost method. So we have the second requirement. The second requirement of the question is like this. It says why replacement interval decisions should be based upon the equivalent annual cost. Now, see, just try to understand. When we talk about the equivalent annual cost, the equivalent annual cost has a formula of present value of the cash flows divided by annuity factor. Divided by annuity factor. Now, equivalent annual cost has a formula which is the present value of cash flows divided by annuity factor. The EAC, which is the equivalent annual cost, is used to compare the different replacement cycles for the asset and to opt for the optimal replacement cycle. Usually, different period replacement cycles are compared. For example, in the current situation where we are comparing the replacement cycle for 2 years and for 3 years and 4 years, the comparison cannot be made for the 3 and 4 year cycle till the time both the cash flows are brought at the same levels. Therefore, in order to bring them using the same base, using the similar base, the equivalent annual cost is used. So what do we use? Equivalent annual cost. Now let's try to understand this. So therefore, in order to bring them using the similar base, equivalent annual cost is used. So that's one of the reasons why equivalent annual cost method is used. Now let's move a bit forward and let's discuss further. Let's talk about the another requirement of the question, which is the requirement number C. If I talk about requirement number C, what is the requirement? Let's see. Okay, it says discuss why discounted cash flow models of investment appraisal are considered superior to non-discounted cash flow methods. Now see what happens is that the non-discounted cash flows do not consider the effect of time value of money. The concept of time value of money is that money loses value over a period of time, and this could be better understood using the example that the goods that you can buy for the money today, a greater amount of funds will be required to buy the same quantity of goods after a year, a greater amount for buying after 2 years, and so on for the subsequent years. So the reason for the money to lose its value is because of the inflation, the rate of returns prevalent, and the other aspects with respect to the relevant investment projects. So therefore, in order to consider the effect of all the above factors, the discounted cash flows are used and are considered superior to the non-discounted cash flows, as they give a more realistic picture. So that is the reason why we use the non-discounted cash flows and we don't use the discounted cash flows, right? So what I've done is that I've discussed with you people about this specific concept, that why do we use this equivalent annual cost? Why do we use the discounted cash flows? Now let's come on to the part A of the question, which was about the calculation using the equivalent annual cost. Okay, now let's just see that what exactly is there in the question. So if I could just come on to the question, let's try to discuss and let's try to understand. Okay, it says Cabrera's company is a construction company, uses a large earth-moving vehicle called the Beast to prepare foundations for buildings. It needs to decide whether the cheapest interval is 3 years or 4 years. Following details are available. The company purchases the Beast from the manufacturer for 800,000 payable 1 year after the delivery. So 1 year after the delivery means this is actually going to be payable at time period 1. Its resale value will fall 40% of the purchase price at the end of its first year. Resale value will then reduce by 25% of the previous year's resale value for each further year of operations. Yearly maintenance costs are 20,000 at the end of first year of operation, rising by 5% per year. Maintenance must be provided in the year of sale. Yearly fuel costs are 28,000 in first year, rising by 5,000 for each extra year it is operated. If the Beast is operated beyond the 3 years, it is subject to a government safety and carbon emissions test. The test would be paid for and would take place at the beginning of the 4th year of operation. Correction of any faults discovered by this test is mandatory. There is an 80% chance that the test and the remedial work will cost 50,000 and 20% chance that it will cost 120,000. Cost of capital is 8%. Now see, this specific cash flow will not be considered because this is an operational cash flow. This has nothing to do with the asset. Like in the first year, rising by 5,000 for each extra year it is operated. That's a yearly fuel cost. That's an operations cost. We are right now talking about the interval cost, right? Okay. So now what are we gonna do? If I say 3-year replacement cycle, I would say time period 0, time period 1, 2, 3, right? Okay. Investment. You are gonna make payment at the end of. When are you gonna make payment? If it is gonna be delivered right now, you're gonna be payable 1 year after the delivery. So you're gonna be paying after 1 year. So it's like 800,000. Right? Number two. What else is there? Its resale value will fall by 40% of the purchase price. So now you would say that the resale value. So resale value is gonna be 800,000 multiplied by 0.6. Why? Because it has fallen by 40%. And then it will reduce by 25% of the previous year resale value for each further year of operation. So then it will be multiplied by 0.75, multiplied by 0.75. Why? Because first year 60% it becomes, then 25% reduction is 75%, then 25%. So hence resultingly, this is what it is going to be, resale value. You have got the maintenance cost. So when I talk about the maintenance cost, what is it gonna be? 20,000 at the end of first year of operations, rising by 5% at the end of each year of operation. Maintenance must be provided in the year of sale. Okay. So hence what happens is that this is the cash flows, the discount factor. Present value. Discount factor is 8%. And the present value is this into this. Right? So this is what the present value is gonna be. So hence what is actually gonna happen is that you would sum up all of this. Now this is 580,433. If I talk about equivalent annual cost, it is actually gonna be this divided by 3-year annuity factor. So this divided by 3-year annuity factor. So hence this is actually gonna become 225,227. This is actually gonna become 225,227. It is per year cost, and I've ignored the fuel cost. I've used the assumption that the fuel cost is not relevant here because the fuel cost is pertaining to the operation and not with respect to the acquisition of this company. Right? Okay, now similarly, I'm just gonna open it up and I'm just gonna put it through for the 4-year replacement cycle. Now, if I talk about the 4-year replacement cycle, what's gonna happen is that this is what it is. Then there is going to be time period 4. The resale value is going to be the maintenance cost is gonna be like this. Hence, what actually happens is that now if I talk about the equivalent annual cost, it is going to be this divided by the sum of, so 200, 156. So on the basis of this, what we can conclude is that the 4-year replacement cycle is suitable. So I would say that the 4-year replacement cycle is suitable as it leads to lower equivalent annual cost, which is $200, 156 as compared to $225, 227 for 3-year cycle. So obviously you would want to go for a lower cost. You would want to go for a lower cost, right? That's what you would want to do. You would want to go for a lower cost. So in order to go for the lower cost, that's what you will do. Yeah, do you people get it? Is this all okay for all of you? Yeah, is this okay for all of you? Yeah, hello everyone. Is it okay to you? Any questions on this? Okay, lovely. Okay, so we are done with this question, which was about this, the equivalent annual cost. I'm just gonna move a bit forward now. I'll discuss the next question, and the next question is basically Melpash company. The requirement of this question It's actually Malpash Company from March June 2022. It says Malpash Company manufactures motorcycle and is considering an investment in a new high performance model. What is the requirement of the question? Requirement is for the proposed investment in new motorcycle, calculate the following, which is NPV, the IRR, the payback period, and the ROCE based on average investment. Then it says discuss suitability of the techniques used for determining whether to undertake an investment and advise whether Malpash proposed investment is financially acceptable or not. Now let's just try to discuss this. I'm giving you 5 minutes. If you could just read through this question, then we're going to start discussing. No, Vijay is not stuck. I just gave you time to actually go through the question. Now let's just start off. Okay, what does it say? It says Melpash. It says Melpash company manufactures motorcycles and is considering an investment in a new high performance model. The market for high performance motorcycles is very competitive, and Melpash directors want to recover the cost of investment in the model quickly before it is made obsolete by more advanced models at the end of 4 years. That means very simple. The project has a life of 4 years. Now, what does it say? It says the directors also wish to show the shareholders that the investment will be profitable. Okay. Directors have set themselves a target payback period of 2 years and a target return on capital employed of 20% for the investment. Directors have also asked the director to provide NPV and IRR calculations for the investment. They plan to consider the results of these calculations if investment fulfills the target for payback and the return on capital employed. The company has prepared following forecasts for production and sales of the new model. So the motorcycles, production and sales, that means zero inventories. All that is going to be produced is going to be sold. Malpash's company's finance director has prepared the following information relating to the investment proposal. The initial investment is of $220 million. Residual value is this. Selling price per year, year one price terms is 20,000. Expected selling price, this. Variable selling price inflation is 6%. Then variable cost, year one price terms. Year one price terms means that it has incorporated the year one adjustment impact. So from year two onwards, we would apply the inflation. The nominal rate is 14%. Expected fixed cost inflation is this. Ignore taxation. Now let's just try to see this. Basically, okay, this is Malplash company. For the net present value calculations, time period 0, time period 1, time period 2, 3, and 4. It says selling price, the variable cost. So you look at the contribution per unit, the number of units, total contribution. Then there is this fixed cost, profit / cash flows. Profit, investment, and then cash flows. Now let's just try to see this. So basically, the selling price is 20,000 per motorcycle. This is at year one price terms, right? 20,000 is at year one price terms. It's actually going to increase by 6%. The variable cost was 14,000, and then again at year one price terms. And this will increase by 6%. So the formula was consistent. So that's why I just copied the formula and I just pushed it there. Then we talk about the number of units. So this is what the total contribution is going to be. The fixed costs are 120 million. Okay, now what I'll just do is that I'll just convert this in terms of million so that it becomes easy for us. Divided by 1 into 10 raised to power 6. So it's like this is what it is. The contribution becomes this. The fixed cost that we have is 120 million. And again, it's at year one price terms. The fixed cost inflation is 10%. The investment was 220 million and the recovery was 30 million. Hence, the cash flows are going to be like this. The cash flows are going to be like this. Right? Then we have got the discount factor, the present value, the net present value. So the discount factor is what? 14%. So hence this is going to be this into this. Resultingly, if you're going to calculate the net present value, it is going to be like this. 16.79 million is the net present value. So if you want to calculate the net present value in this scenario, the net present value is going to be like this. I've prepared one video where I've used the shortcuts of all of this. I've prepared a video for the CB practice platform that you can use, and that actually includes the shortcuts for all of this, that how do you actually use them in the CB practice platform. Yes, you can use. You can use, it's given in the examination. I'll share one of the videos which I've prepared. I'm sorry, I'm not using the CB practice platform right now. And the major reason behind that is that at times it's not working, so it becomes very problematic situation. Okay, so for the IRR, it's gonna be the formula of IRR, these values, comma, any guess, let's say 10%. So you get the IRR to be 17.7%. So the IRR is 17.7%. Now what happens is that what else do we want? We need to calculate the payback and the ROCE. The payback period is going to be calculated how? You would say here, you would say cash flow, cumulative cash flows. So it's a this plus this. the cumulative cash flows become positive here in the year 3. So hence, payback is going to be 2 years plus. Plus how much? It's like 35.8 divided by this. So 2 years, 0.87666666. Hence, total payback is this many number of years. Is this many number of years. This is what the total payback is going to be. This many number of years. Right? Okay, just a second, please. Just allow me a minute. I'll just continue. Okay. So the total payback is this 2.29 years. That's what we have got. Now let's move a bit forward, and then return on capital employed, which is based on average investment. Now see, um, the depreciation, has he given any information about the depreciation? Okay, so the cash flows are there. We just have to see if we can calculate the profit. The depreciation is not given. Okay. First of all, average annual profit, I mean, for the return on capital employed, return on capital employed, average annual profit divided by average investment. The average investment is opening plus closing divided by 2. Is opening plus closing divided by 2. So the average investment is going to be 125. Is going to be this plus this plus this minus. Minus, basically what happens is that what am I doing? I'm actually adding up all the profit minus this depreciation, the 190 million divided by 4. This is the average annual profit, right? This is average annual profit. This is average annual profit. Now, if I talk about the ROCE, or the accounting rate of return, it is going to be this divided by this. Hence, it gives you 11.73, the accounting rate of return. This is when I have actually considered the depreciation, including depreciation, including depreciation, right? Now, there could be one more calculation, which is excluding the depreciation. Excluding the depreciation, the average investment remains the same. The average annual profit is going to be the average annual profit is going to be so this is not reasonable. What is reasonable is this one. What is reasonable is this one. This is not reasonable. This one is more reasonable. The one where we incorporate the depreciation. So examiner is asking for this all calculations, net present value, IRR, the payback period, and the return on capital employed. So what have we done? We've actually been able to incorporate all this. Now it talks about discuss the suitability of the techniques used in A for determining whether to undertake an investment and advise whether Melplesh company's proposed investment is financially acceptable or not. So what do we need to do? Uh, when this specific question comes in, it says discuss the suitability of the techniques used in A for determining whether to undertake an investment and advise whether Melpash company's proposed investment is financially acceptable or not. So what are we going to do? Let's just try to understand this. So net present value, I'll just write down few pointers. Considers cash flows. Discounted cash flows are considered. All cash flows throughout the life are considered. Non-cash items are ignored. The non-cash items are ignored. And what else is there? So these are few things with respect to the net present value. Now, with respect to the IRR, the best technique to consider the investment similar to NPV expresses return in terms of percentages. The beyond this, hence this indicates that it is a viable investment. The payback period only considers the cash flows till the date of payback, ignores time value of money, return on capital employed, not suitable method as the situation beyond the payback date could be entirely different. Furthermore, target payback was 2 years, whereas the project has a longer payback. For the return on capital employed, depreciation is incorporated. Profit is considered instead of the cash flows. The average investment not necessarily reflects the The average investment not necessarily reflects the investment at the appropriate weight. So there are problems with this specific technique. There are problems with this specific technique. Yeah, do you people get it now? Okay, lovely. So we have been able to do this Malplash company also. Now, this is the last question for the day that we are going to cover up. The name of the question is Hawker Company. Hawker Company. Requirement is evaluate whether Hawker should use leasing or borrowing as a source of finance for the new vehicle. So you have to decide lease or borrow. Discuss two reasons other than after tax advantage why Hawker Company may choose to lease rather than buy the new delivery vehicle. Three advantages of using NPV rather than IRR in the investment appraisal. Okay, sure. We will make it available on the YouTube. Don't worry about it. Yeah. So can you just take 5 minutes and try to do this question, please? Okay, Kasim, I'll just continue and I will conclude the class. You can watch the recordings. Okay. It says Hawker Company is about to replace its existing delivery vehicle with a new design of vehicle that offers greater fuel economy. It estimates that replacing the vehicle will save the running cost of $2,000 a year. Okay. So they want to replace a vehicle and it's going to save them $2,000 a year. There are two financing options, the option number one, the option number two. Now see this $2,000 a year is going to be the same in both the cases, whether you use option one, whether you use option two. So you could largely ignore that also. Vehicle could be purchased for $34,000 using a bank loan with an after-tax cost of borrowing of 4% a year. The vehicle could have a useful life of 4 years and would have a residual value of this at the end of that period. A straight line tax allowable depreciation is available on the vehicle. Vehicle would be subject to government CO2 emission tax of 600 at the end of operation. Emission tax expenses are corporation tax deductibles. Okay, so they're deductible tax. Then it says the vehicle would be leased for a period of 4 years for a payment of 6,000 a year, payable at the start of each year. Lessor will pay the commission tax. Lease payments are corporation tax deductible expense. Hawker's after tax weighted average cost of capital is 8%. It pays corporation tax at the rate of 20% 1 year in arrears. So now you've got one option which is leasing. You've got one option which is borrowings. Now let's just try to see that what is actually going to happen. What are we going to do with respect to all of this? Okay. So we have got the Hawker company. We've got Hawker company. For the Hawker company, what's actually happening is that it says the vehicle could be purchased for $34,000 using a bank loan. Bank loan 0, 1, 2, 3, 4, 5. Vehicle cost, the depreciation, the tax savings on, okay, the depreciation, CO2, emission tax, total expense, tax savings, then depreciation needs to be added up, so you end up getting the cash flows. $34,000 and then the residual value will be $14,000. The depreciation is going to be minus tax savings are going to be minus the sum of this multiply by 20% because it's payable 1 year in arrears. So like the year one savings are gonna rise in year two in year three in year four, so on and so forth. Then what we need to do is that we need to add back the depreciation because it's a non-cash item. So the cash flows are gonna be what? Right, so these are the cash flows. Discount factor at 4%. Discount factor at 4%. Hence, resultingly, what happens is that the present value of this is gonna be so 20,301. 20,301. 20,301. This is about the bank loan. Now let's just talk about the vehicle lease. So if we talk about the lease, so what's actually gonna happen is that you'll be paying $6,000 at the start of each year. 6,000. Now what else is gonna be there? The depreciation won't be there. The CO2 commission tax is gonna be there. The tax savings is gonna be okay. So the tax savings is gonna be like this. Hence, what would happen is that you'll get the cash flows like this. For these cash flows, the discount factor should be 8%. So hence 19,107 is what the present value is going to be. So obviously, what are you gonna adopt? You're probably gonna go for the lease. You're probably gonna go for the lease. Why would you go for the lease? Because that's actually that's actually a lower cost option as compared to the other situations. Now, the next requirement of the question is discuss two reasons other than this, why they may choose to buy, to choose the lease rather than buy the new delivery vehicle. That's something that we need to talk about. So what do you think? Why would they go for that? Okay. Um, Reasons for preferring lease as compared to buying is that outflows are different when compared to lease and buying as the lease would require annual payment, whereas buying out would require a greater initial payment. Just a minute, I think that I've made some mistake. Lesser will pay the CO2 tax. Sorry, the lesser would pay the CO2 tax. So CO2 tax would not be there. So that's one of the thing. The lesser would pay, right? Now the second reason is that the risk a significant cost related to the maintenance is borne by the lessor plus the decline in values are also borne by the lessor. The three advantages of using NPV rather than IRR in the investment appraisal. It's an absolute measure that is expresses results in terms of amounts that would arise of the because of the investment does not consider the assumption that the cash flows are reinvested at the rate of return at the rate of IRR, which is a vague assumption. IRR gives multiple results in case of non-conventional cash flows. That is when negative cash flows arise in between positive cash flows. Right? So do you get it? Okay, good enough. So what have we done? We've actually been able to do these questions on the investment appraisal, and I hope that you people would have actually understood these. And in case if there are any questions that you may have, please, you are most welcome to ask. I'll be happy to answer those questions. Just in case, if you have got any questions, you're most welcome to ask. I'll be happy to answer them. right? Do you get my point? Yeah. Is there any question that you have, please? You're most welcome to ask. Okay. So thank you very much, all of you, for joining in. Thank you for your time. Thank you for being here. We're going to continue in our next session, which is day after tomorrow, and we'll take it up from there. The recordings will be uploaded on the YouTube, and they would be shared with you people in the WhatsApp groups too. So thank you and take care.